In this video, we teach you how to invest in real estate as a starter. Real estate investing has long been hailed as one of the most effective ways to build wealth, but for beginners, it can feel like a labyrinth of decisions and potential pitfalls. The idea of owning rental properties, managing tenants, and navigating the financial landscape of real estate might seem daunting, but with the right approach, it can be one of the most rewarding investments you'll ever make. This guide is designed to break down the complexities of real estate investing into manageable steps, focusing on rental properties as a starting point. At its core, real estate investing follows a simple premise. You purchase a property, rent it out, and generate income while the property appreciates in value. This dual advantage of cash flow and equity growth is why so many people are drawn to real estate. However, the process requires understanding the nuances of financing, property management, and market dynamics to ensure success. Let's begin with an example to illustrate how this works in practice. Imagine you have $30,000 to invest. You decide to use this as a down payment on a $300,000 property. With a 30-year fixed mortgage at an interest rate of 4%, your monthly mortgage payment for principal and interest would be approximately $1,289. Adding property taxes and insurance, your total monthly expenses might rise to $1,939. If you can find tenants willing to pay this amount or more in rent, you've covered your costs while your tenants essentially pay off your mortgage for you. Over 30 years, assuming an average property appreciation rate of 4% annually, your $300,000 property could be worth nearly $973,000, transforming your $30,000 investment into a nearly $1 million asset. This incredible growth is made possible by leverage. Unlike stocks, where your returns are based solely on the amount you invest, real estate allows you to control a large asset with a relatively small initial investment. In this scenario, your $30,000 is leveraged to purchase a $300,000 property, and it's the entire value of the property appreciating at 4%, not just your initial investment. This is the power of real estate and one of its greatest appeals. In addition to building wealth, real estate offers a unique hedge against inflation. As inflation rises, so do property values and rents. Owning real estate means that while the cost of living increases, so does the value of your investment, allowing you to keep pace with or even outstrip inflation. Imagine owning a property outright with no mortgage, providing a steady stream of rental income. This level of financial security is unmatched by many other investment options. That said, real estate is not without risks. There are many potential challenges, from bad tenants and vacancies to unexpected maintenance costs and market downturns. For beginners, these risks can seem intimidating, but they can be mitigated through careful planning and informed decision-making. Finding the right property, the first step to success. The foundation of any successful real estate investment is finding the right property. Not every property is a good investment, and jumping into the market without due diligence can lead to costly mistakes. Before purchasing, it's crucial to evaluate potential expenses, mortgage payments, property taxes, insurance, and maintenance, and compare these to expected rental income. Research the local rental market to ensure your figures are realistic. Many properties may not generate enough income to cover expenses, so patience and thorough research are key. When evaluating properties, location is everything. Properties in desirable neighborhoods, near schools, public transportation, and amenities tend to attract more reliable tenants and command higher rents. Additionally, consider the property's condition. A fixer-upper might come with a lower purchase price, but the cost of renovations could quickly eat into your profits. Balance the upfront savings with potential renovation costs to determine whether the investment makes sense. Structuring your investment for protection. Once you've identified a property, it's essential to structure your investment properly. Operating through a limited liability company, LLC, is a smart move, as it shields your personal assets from liability. If an accident occurs on your property and you're sued, the LLC ensures that only the assets held by the company, not your personal assets, are at risk. To fully benefit from this protection, you'll need to transfer ownership of the property to the LLC, which may require consent from your mortgage lender. While this might sound complicated, it's a straightforward process that a real estate attorney can handle for a reasonable fee. Insurance is another critical aspect of protecting your investment. A landlord insurance policy covers property damage, liability claims, and loss of rental income due to covered incidents. While it's not legally required, it's a safety net that can save you from significant financial hardship. Managing tenants and building a positive rental experience. Managing tenants is one of the most challenging yet vital aspects of real estate investing. The success of your investment depends largely on the quality of your tenants. A thorough screening process, including credit checks, background checks, and employment verification, can help you find reliable renters who pay on time and take care of the property. While the screening process might seem tedious, it's worth the effort to avoid the headaches of dealing with late payments, property damage, or eviction. Even with the best tenants, issues can arise. It's important to have a clear lease agreement that outlines expectations, such as payment, due dates, maintenance responsibilities, and penalties for violations. Addressing problems promptly and professionally can prevent small issues from escalating into major conflicts. If managing tenants feels like too much work, hiring a property management company is an option. Property managers handle tenant screening, rent collection, maintenance, and legal issues, allowing you to enjoy the benefits of real estate investing without the day-to-day responsibilities. However, their services come at a cost, typically a percentage of the monthly rent. Make sure the added expense aligns with your investment goals. Understanding the financial side of real estate. One of the biggest advantages of real estate is its tax benefits. Rental property owners can deduct expenses such as mortgage interest, property taxes, insurance, maintenance, and even depreciation. Depreciation is a unique tax deduction that allows you to write off the gradual wear and tear of the property, even though it's likely increasing in value. These deductions often offset rental income, reducing your taxable income significantly. When it comes time to sell a property, planning can save you from a hefty tax bill. A 1031 exchange allows you to defer capital gains taxes by reinvesting proceeds into another property. Alternatively, holding properties as part of your estate can provide tax benefits for your heirs, as the property's value resets to the current market value upon inheritance. Real estate is a long-term investment, and success requires patience and perseverance. Starting small, with a single-family home or duplex, allows you to learn the ropes and gain confidence. Over time, as you build equity and experience, you can expand your portfolio, exploring opportunities like commercial properties, multifamily units, or even short-term vacation rentals. The journey won't always be smooth. Market fluctuations, tenant turnover, and unexpected repairs are part of the process. However, with preparation, persistence, and a willingness to learn, you'll discover that the rewards far outweigh the challenges. As you gain experience and confidence in real estate investing, you'll naturally start looking at ways to expand your portfolio and maximize your returns. Scaling your investment from a single property to multiple properties introduces new opportunities, challenges, and strategies. This phase of your journey is where you truly begin to unlock the long-term potential of real estate. To illustrate the power of real estate investing, let's walk through a real-life scenario. Imagine you purchase a $200,000 duplex with $40,000 as a down payment. The property has 2 units, each renting for $1,200 per month. After accounting for your monthly expenses, mortgage, taxes, insurance, and maintenance, you're left with a net cash flow of $600 per month. Initially, you use this cash flow to build an emergency fund for unexpected repairs. After a few years, the property appreciates to $250,000, and you've built up $25,000 in equity through mortgage payments. You decide to use a cash-out refinance to access $20,000 of that equity, which you use as a down payment on a second property. Now, you own 2 properties generating rental income, and the cycle continues. Over the years, your portfolio grows, providing a steady stream of income and significant wealth through appreciation. Building a diverse portfolio. A crucial step in scaling your real estate investments is diversification. While it may be tempting to stick with what you know, like single-family homes in your local area, expanding into different types of properties or markets can significantly reduce risk. For instance, you might consider adding multifamily units, commercial properties, or even vacation rentals to your portfolio. Multifamily properties, like duplexes or apartment buildings, can offer higher cash flow and lower risk compared to single-family homes. If one tenant moves out, you'll still have rental income from the other units. However, they often require a larger initial investment and more hands-on management. Commercial properties, such as office spaces or retail buildings, tend to have longer lease agreements, providing stable income for years. They can also offer higher returns, but they're more susceptible to economic downturns, as businesses may close or relocate during tough times. Vacation rentals, popularized by platforms like Airbnb, can yield substantial profits during peak seasons. However, they require constant attention, marketing, and management, and they're subject to fluctuating demand and local regulations. Exploring real estate markets. When expanding your portfolio, researching different markets is essential. Property values, rental demand, and appreciation rates vary widely depending on location. If your local market is saturated or offers limited growth potential, consider exploring other cities or states. Look for areas with growing populations, strong job markets, and a stable economy. College towns, metropolitan suburbs, and vacation hotspots often have high rental demand. Keep in mind, investing in out-of-state properties requires a reliable team of property managers and contractors to handle operations on your behalf. Leveraging real estate financing. Scaling your portfolio often means leveraging financing effectively. While cash purchases eliminate the burden of monthly mortgage payments, they tie up a significant amount of capital that could be used to acquire multiple properties. Instead, many investors use a mix of financing options to grow their portfolio while maintaining liquidity. If you've built equity in an existing property, consider using it to fund your next investment through a cash-out refinance or a home equity line of credit, HELOC. These options allow you to borrow against the equity you've accumulated, providing funds for down payments on additional properties. Additionally, partnerships or joint ventures can provide access to more significant capital pools. Partnering with other investors allows you to tackle larger projects, like apartment complexes or commercial developments, that would be challenging to fund alone. Real estate investing may seem daunting at first, but with the right knowledge and strategies, it can become a powerful tool for building lasting wealth. If you found this video helpful, don't forget to like, subscribe, and share your thoughts or questions in the comments below.